As we know, as companies start, they need to grow. Unfortunately, majority of these companies die. And there's so many reasons why some of these companies die. And one of them could be running out of money or failing to raise money. So we need to know what is happening at a continental level, what is happening in Tanzania. What do we need to do as a country to, one, attract more investments to Tanzania, but secondly, what can we do to mobilize local capital, which for me is the most important. You have Tanzanians working in the corporate space. They lose money every day. They buy farms, they go into matikiti maji farms and all that, yeah? But they lose money. So what do people do now? They end up investing in traditional financial markets. They buy bonds. Each bond, as you see, BOT is announcing is oversubscribed, whether it's corporate or treasury bonds. People invest in stock markets. People invest in UTT. Do you know how much money has been invested in UTT? 3.2 trillion. It's a lot of money in UTT, but we believe we can diversify some of these funds and reallocate at least 5-10% of that money to startups if you can put the right things in place. There's a lot of money in SACCOs, 1.1 trillion total assets in SACCOs, Tanzania. So I think we can tap on some of this money and see how can we reallocate to startups. So you'd see venture capital investing in Africa so far in 2025 is about $313 billion. This is how much money venture capitalists have invested in startups globally. So in North America, you see the largest, it is $182 billion. And then, of course, next you have Asia, which is about $65 billion next to North America. As we all know, there's a lot going on in Asia. AI, EV, and all that kind of stuff. Then, of course, Europe, followed by Latin America and Africa, trying to play catch up, 2.6. But one thing we should also know that as much as we're trying to build more startups, startup economy in general in Tanzania, and trying to attract more venture capital money, it's still a small industry. And still many startups are struggling to raise money. Less than 1% of startups manage to raise money from venture capitalists this year so far. An average investment per startup globally is about 2.2 million. 45% of all these venture capital investments globally went into software and AI. This might not be the case in Africa. In Africa, almost the same number of investments by venture capitalists went to fintech. So fintech is still the largest recipient of venture capital money. But one thing we should know is 70% of startups fail within the first 5 years. This is a common statistic which has been around for a while. If venture capitalists invest in a startup, one of the things they expect is to return their money plus some sort of return over a certain period of time. So they have to do what we call exit. So what happened is only 1.5% of exits which were done last year were exit at least of $50 million. And guess what? As much as it is a hassle to raise money, startups are being formed almost every day. Why? Because there are a lot of problems. Startups need to come up with solutions, innovation to address these problems. So globally, per year, 30 to 50 million startups are formed every year. 30 to 50 million, which is almost equivalent to 137,000 startups formed every day. Less than 1% of these will get money from a VC. So you need to be exceptional to raise money from a VC. That's why today we're going to talk about other sources of financing. You don't want to hold a traditional commercial bank to account why they're not investing in startups, but that's not their space. The same thing applies to VC. So VC will not necessarily invest in everything. So if you want to build a startup economy in any country, you need to have multiple sources of capital that would address different needs, different stages, different sectors, and different requirements of our businesses. There's a lot of factors. Of course, one of the reasons I think some of you who have been following up about venture capital is report, I think the year before last, said 73 to 74% of founders who raised money from venture capitalists were educated outside Africa. So there's a bias in terms of who starts a company and who gets the money. That's why you need to set up your own funds. Yeah, you don't have your local funds, there's nothing you can do, trust me. You must have your local funds that understand the local environment, that understand you, that know who you are, the environment you come in, that understand the risk as you see, not the risk as they perceive on the media. If you look at the trend between 2021 and 2024, number of investors who have been coming to Africa, not necessarily coming, but investing, active investors has been going down. You can see from 2021, the first column on the left, to 2024. So out of 520 investors plus VCs who were investing in Africa last year, only 390 of those invested at least $100,000. And then, of course, as you go up higher, only 110 around there made between 2 to 4 deals. And interesting, only 15 out of 520 did 5 to 9 deals. And it's only 8 venture capitalists out of 520 did 10 plus deals. What it tells you is you have so many investors, but not all these investors are investing massively. So this is another thing that we also need to understand when we talk about what sort of funds you are building up, because I think there'll be one of the discussions today. So last year has been not the best. If you look at the statistics, the yellow graphs you see, the bar, represent the year. So 2019, Africa, all startups in Africa raised about $1.4 billion. And 2020 was about 1.1, slightly lower. You know what happened at the time, COVID and everything. 2021, we did well, $4.4 billion. 2022, this was the best year, at least for the past 5 years. African startups raised about $4.6 billion from VCs, venture capitalists. So when you're starting up as a founder, you didn't know how much money is available in the market for you to work hard to attract this money. Could be you, could be maybe 5 of you, could be 10 of you in this room. So we wish each one of you who's starting a business and raising money should get the money. Unfortunately, that's not the way capitalism works. Kenya last year was the leader. Kenya attracted most of the venture capital investments in Africa. I know some of my friends don't like me when I compare Tanzania to Kenya, but you have to. You have to. It's your naturally economic rival. It's almost like US and China, no? It's almost there. So we are next with the second largest economy in East Africa. So we track what's Kenya doing. What are we not doing, what they're doing? But again, you can also look at amount of capital that has been coming to East Africa, at least for the past 5 years, between 2019 and 2024. So one thing you'd see is Africa, East Africa in particular, last year received 1/3 of all venture capital money that came to Africa. And guess what? For a period of 5 years, amount of venture capital investments that went to Kenya was $3.3 billion. And the amount of venture capital money that came to Tanzania for 5 years was less than 300 million, which is less than 10% for 5 years of money that went to Kenya. You know, is it policy? Is it the ecosystem? Is it the startups? Of course, there are a lot of reasons why fintech has remained to be the most attractive sector to most of these investors. But it's changing. The landscape is changing because other sectors are now coming to the shore, like energy. So climate, energy, renewable energy in particular. We know what is happening with climate change. Landscape is changing. Capital now moves to different directions, almost 20%. But that 20% should not fool you. It's very few companies, because energy companies tend to raise big amounts because they're asset-heavy businesses. So it might be 20%, there will be 4 or 5 different companies. And then we have logistics and transport, which for me, I would say we have been sleeping on this industry. Huge potential, especially for Tanzania, 13%. And then, of course, you have the likes of healthcare, agri and food services, education, retail, and all that. And education has been one of the sectors in the venture capital world that has been receiving less and less venture capital money for a long time, despite the importance of the education industry. 51% or plus of SMEs in Tanzania are female-owned. Do you know that? And Tanzania has more than 4 million small businesses. So there are a lot of female founders, and yet they receive less than 3% of all the money comes here. So I don't know, you need affirmative action, I don't know. But these are the things we need to talk about. And these are the things that need solutions. Because young girls go to universities, they graduate, some don't, but they're innovative, they're entrepreneurial, they want to build stuff, but they can't get the money. It's a big challenge, trend. So what is happening now? Because with all these challenges, of course, they are good stories. They are good stories. So don't paint it just a gloomy picture that this is all about VC. No, as we see. But when it comes to venture capital, one of the things which is important is for fund managers, people such as yourselves who are trying to set up funds, to be able to raise money locally. Because it's tough. It's tough for a fund manager to raise money at the global stage, the same almost as a startup founder trying to raise money. Ghana has just passed a policy that would require pension funds to allocate at least 5% of their assets to venture capital and private equity. It's a long time coming, because African pension funds have more than $4 trillion in assets. But it's very tough to get this money. I've had discussions with some of the director generals of the pension funds. I worked in pension fund myself in my employment days. And I'd see bad investments way worse than startups, if they think startups are risky. Another thing which is important to note is, in the past, VCs tend only to invest in tech startups. But that is changing now. So SMEs are now making now in the pipeline of businesses that VCs also want to invest. And of course, we now see corporates coming to the show, trying to see if they can also invest in startups. So what has been happening is, I've had these discussions with a lot of corporates. Of course, we're in discussion at a firm level with 3 corporates. The idea was to ask the likes, let's say, a bank which has 15 trillion in assets, say, you know what, with profits, I don't know, 400 billion plus, just take 5% of that money and start what we call corporate venture capital fund, CVC. Don't ask me to go to a Vodacom Foundation or CRDB Foundation. They won't cut it. You have to set up a proper VC structure as an arm or a subsidiary of a bank. So if a startup, you go to a bank, they tell you, no, as a startup, you cannot qualify. You don't have collateral, you don't have 3-year period track record, but we have a VC fund. You can apply for that. Do you understand what I'm saying? So that's how the corporate world can really support. Not these running, competitions and then, prize money, $5,000. The demand is insanely huge in the market. We need properly structured schemes that can support startups. And we have the knowledge to do that if people allow us to do that. Another thing which is happening, as I'm finishing, is startups tend to grow merely organically, getting the money from VCs, and grow. But this is changing now. We see a lot of mergers and acquisitions within startups. We saw Asoko merging with another e-commerce in Egypt to form one company. There will be a lot of consolidation in the fintech space, fintechs buying other fintechs as well. So this is happening now, startups buying other startups. It's normal for someone to start and fail and start again. It's entrepreneurially correct. That's why, what is the culture of Facebook? Fail fast, yeah? So you start, you fail, you start, you grow. But in Africa, if you start a business and fail, if there's a family meeting you don't want to attend, because people ask you about the business. It's like a curse. This is pretty much what I wanted to say. Asanteni sana.
So my name is Taha. I'm founder of Beam. We're a Pan-African customer communication platform. We've been around for now 15 years, so I've lost track at some point. But we've been in I call it the startup game or the startup race for some time. And we've seen the evolution of the ecosystem because when we started, I think it was very nascent ecosystem. We build software and systems for businesses to communicate with their customers on different mobile channels, SMS, USSD, airtime, and chat. And we do this across 25 different markets in Africa.
So what I heard is you have done all that without venture capital money. Is it correct?
That's correct, yeah.
So maybe you can share some experience with the audience here. Why did you decide not to seek? Because you've been there since day one. You have seen the narrative of venture capital. Why not? Why not venture capital?
I remember going to competitions. I think at that time where there was a Pivot East in Nairobi and things like that. We went to many of these competitions. We spoke to many VCs the few that were there. VC would give us a different reason at that time. Either you don't have the strong team, or your product is too not good enough, or the market is too small, or whatever, right? So that was that. And then we had a second attempt. It was much later, around 2020. This is after COVID, so 2022, 2023. We looked at raising again. This time, we were already profitable and growing. The main thing that came out of that was all of the discussions. I was spending more time explaining our business to the VCs, right? Part of the reason we said, okay, this doesn't make sense, is because we didn't think they were going to add value to our business. So that's kind of our track record.
So usually we also have this practice that before you take money from the investors, of course investors tend to do due diligence on founders. But you, of course, you went further. You also did due diligence on investors. And also always tell people to do that, because you need to know if there's a fit and if they're genuine, if they're the right people for you to bring on board. So how did you do that? And did you tell the investor that you are doing a DD for them?
No, I didn't. So I used whatever networks I had to find out what I could.
So when you started, as you said, it was just a handful of VCs actually at the time coming to invest in Africa. And the environment was pretty much tougher than now. But the landscape has changed now. We have 500 plus VCs that are investing in Africa. You have the likes of Afri Capital that help companies to raise money. So you have more, because in the West, we all know, companies don't raise money. It's the intermediaries, it's the investment banks and advisors who do that. If we were to do it again, would you go for VC, given the current environment now?
I think we definitely have a more improved environment. I think the market is better in terms of availability of funds back then, compared to back then. I would still not raise money early on. I would raise later.
Okay.
Because I think our markets take longer to find product market fit. Once you've figured out product market fit, then use the VC money to accelerate.
Yeah.
So I think that's a distinction that I would make, that we're not ready yet in terms of, if we look at SaaS, let's say B2B SaaS, it's not there yet, right? So I would make that clarification.
Okay.
But yes, I think the money is there. Tanzania alone is too small a market for any business, any startup, tech startup. Tanzania alone is too small, right?
Yeah.
So either you need to be looking at 3, 4, 5 African markets or the entire region. And so you will need to grow beyond Tanzania. And I would urge people to start thinking about that from day 5, like as soon as you have your basic product, like start thinking about, okay, is there a market for this beyond Tanzania? Because otherwise it's too small.
So when it comes to partnerships, the other reason why I asked you that, you talk to some founders and advise them to seek partnerships with corporates, who be banks, telcos, and then there's this notion that they ask me to send a proposal, they'll steal my idea. How would you go about that? Is it a fallacy? True?
No, I think it can be true. I've seen and heard many cases of this. There's a recent case in Kenya, I think there was a discussion around how the startup was completely sidelined after they got to an advanced stage. So I think it's something you have to be mindful of. If you can do without them, do it without them first, right? Because they will lock you in to a certain extent, or will try lock you in, and that may limit your growth, right? So you really have to read the fine print, maybe do a proof of concept, do all of these small things to kind of validate their appetite and their how willing are they to work with you, how flexible are they with you, what kind of terms are they giving you. Is it just one person? Sometimes it's the person on the other side. What if they leave? If that person leave and the next person comes into that position and they, don't see it as a priority, is that going to change things for you? But really structure it, think about it, and get some advisors who've done this before to help you look at your, if there's blind spots that you've not missed out on. Right?